Hello and good afternoon, everyone. Welcome to this webinar on HDFC Securities. This webinar is going to be about how you can efficiently track sectors and group companies using small cases and HDFC Securities. My name is Vikas Bardia. I'm an AVP-Growth at small case, and today we'll see how you can, if you have defined views, if you have views on a broader economy or specifically on a particular sector, how you can take advantage in that by investing in some of the ready-made small cases and portfolios that we have created, so that you can efficiently track and gain exposure to those sectors. So before we start that, one second, let me quickly get into full screen mode. All right. So before we start and get into details of how you can invest in these different sectors, let's quickly get an understanding as to what are sectors. So sectors is nothing but simplistically, very simply speaking, it's one of the most common ways to categorize the various companies and industries that we see in the economy. So the economy is categorized into different sectors, each with different meaning. There are even categories like primary sector or secondary sector, manufacturing or services sector. There are all these different terms when it comes to actually the overall economy, and all that everyone's trying to do is categorize a group of companies in a particular broader category. In the stock market, sectors actually have a very defined meaning, where it means a collection of companies that operate in the same broad industry. So you will see auto sector, or you will see banking sector, metal sector. What people mean by that are all the companies that are listed on the exchange that meet that index criteria. They kind of end up becoming the sector for that. They become representative of the larger sector. So when we talk about stock sectors in the stock market, we are actually referring to a particular defined industry or a defined sector, and specifically a collection of companies within that defined sector or industry. So just like there are indices like Nifty 50 and Sensex 30 that track the broad performance of the overall stock market, similarly, there are indices that track a particular sector. So, for example, the Nifty Bank Index, that is a index of the 12 most liquid and capitalized banking stocks in India. Now, is that the entire banking sector? No. But as with the Nifty 50 index, similarly, the Nifty Bank Index is just a collection of a handful of securities which give an insight or a picture into the overall sector. Similarly, the Nifty Metal Index comprises of 15 stocks that are representative or probably have a market share of 80% of the entire metals industries. But they again don't comprise the entire metal industry. The 15 stocks kind of are representative of the overall industry and help you track the behavior and performance of the overall sector. And this includes mining as well in this case. So that is what we mean in the context of stock market when we are talking about sectors. But keep in mind, at the end of the day, it's nothing but just a categorization of companies, or collection of companies that meet or have similar objectives and operate in a broader similar industries. Now, the first thing that comes to mind when anyone talks about sectoral investing or broader sectors is how, which kind of a sector does which kind of um, economic cycle do the sectors follow. Broadly speaking, sectors are classified or divided into two types. One set of sectors are called cyclical sectors or cyclical sectors. These are sectors that follow cycles that are similar to the economic cycle. So for example, of late there's been a lot of talk that GDP growth has slowed down, the economy is slowing down. These kind of sectors will also slow down as a result of the economy slowing down. So their fortunes, the growth of this sector is tied very closely to the growth of the overall economy, and they move in sync with that. So if the overall economy is increasing, people are spending more on the people have more to spend these sectors will witness more growth. If there is an economic downturn and people stop spending or they spend less compared to how they were spending earlier, automatically these sectors will also witness a decline in their fortunes, a decline in their revenues, because there is they stand to benefit less because people are now spending less. So such sectors are called cyclical sectors. You may not have known the term, but you definitely would have experienced it. For example, if people are going through difficult times, they are unlikely to buy a new house, or they are unlikely to buy a new car, or they are unlikely to buy consumer good appliances like electronics, or like refrigerators or an LCD TV. These things, these spends happen much more commonly when when the economy is doing well. People have more disposable income. They have more income in general, and that's why these companies that operate in these sectors are called cyclical companies, and these sectors themselves are called cyclical sectors because they are very in tune and in sync with how the economic expansion and contraction is happening. On the other hand, there are certain sectors which are in regular demand irrespective of how the economic cycle is or where the economic cycle is. um, these sectors relative to the cyclical ones, they see a constant amount of spending, so as to say, irrespective of how the economy is doing or whether people have disposable income or not. They some of these spends could be categorized as something as very basic spends that you will still incur irrespective of whether you have made certain gains or not. And in all of us would have experienced this in real life. Example, just to take that electricity, for example, your electricity bill, you have to pay no matter whether your personal business is doing well or not, or whether you have got a bonus in your salary or not. You still need to buy basic food. If you fall sick, even if you let's say have faced an economic misfortune but you fall sick, you still have to go to the doctor. These things, these industries and these sectors, they have less correlation with the overall economic cycle. um, Compared to this, one thing to keep in mind is that compared to the cyclical sectors, the defensive sectors perform also differently. So when the economy is booming, everything is going better than expected, the cyclical sectors seem to do better because they witness more growth, because a lot more spending is happening there. uh, but the defensive sectors tend to outperform the cyclical sectors when actually the economy is slowing down. That's because, as we just discussed, in cyclical sectors, people may not be buying new cars when there is an economic downturn, but they will definitely go for good healthcare, or buy basic FMCG products or pay their electricity bills. That's why these defensive sectors tend to outperform when there is actually an economic slowdown compared to the cyclical sectors. So keep in mind that these are the two broad type of sectors. Um, this is actually one of the foremost things that people think of when they actually decide to invest in a particular sector. It starts off with kind of having a view of whether the economy is going to do well or not in the coming years, and if it is, which of these sectors within that within will benefit most from that economic boom or slowdown. So if someone anticipates that there is an economic slowdown coming, then it doesn't make sense to invest in sectors which will only do well if the economy is broadly doing well. On the other hand, if someone expects that the economy is expected to do well, then it makes much more sense for them to invest in cyclical stocks or cyclical sectors than it would to invest in sectors which tend to do better or well when the overall economy has slowed down. So that's what that's what sectors allow you to do. They allow you to take a view on the broader segment of the market. um, this way of investing is actually ideal for people who have a broader expertise or understanding of a particular domain. So let's say you work in the IT sector, or you work in the pharma sector. Obviously, you will have a lot more additional knowledge of the broader industry how it's, what are the latest developments there, how it functions, the nuances of it. Even let's say if you are a businessman in the manufacturing segment, or if you sell products that are related to the metals industry, all of these things helps you get additional information about a particular sector of the economy. And if in your research, or as in how you are learning and doing your work in this particular sector, you end up forming views about that particular sector, then investing in sectors actually ends up being a great way for you to benefit from having those views, right? Or because of that increased confidence or that increased knowledge that you now have in this. So investing in sectors is actually a great way to take a specific bet, or a specific to take advantage if you have defined views on a particular segment of the economy. And honestly speaking, in today's day and age, uh, pretty much all parts of the economy now have very defined segments or indices on the on exchanges, that you can now take advantage, that you can specifically track and take advantage of. So investing in sectors helps you get that exposure to a very specific part of the economy and benefit from that. Now, as you can see, I've put screenshots here on HDFC Securities. Right now, you'll find many different sectors in which that you can, quickly invest in a very simple manner. You don't have to do the research yourself. For example, if you think oil and gas, the overall industry in India will do well. Now, you could think that for many reasons. It could be due to decrease in oil price. It could be due to global tensions in the oil market regarding its supply. If you for we if for any reason you feel that oil and gas will do well, now rather than having to do the research yourself to figure out which are the good companies in that space, what we have done is created this oil and gas pack, where you can invest in those companies that our research team thinks will do well. And you can do that in a very simple one click manner and get exposure to that entire sector and track the developments of that. Similarly, there, as you can see, there are small cases and packs that have to do with the life insurance sector or the pharma sector. If for any reason you have defined strong views that one of these sectors is going to do well, then this becomes a very convenient way for you to get exposure to that particular sector. For example, the insurance industry. Now the insurance industry really took off from mid 2019 onwards. Returns have been phenomenal, in some cases even being more than 50-60% over 5-6 months. Now if, for example, you had a view that this sector looks promising and will grow in the future, a lot of people still believe that insurance has a great scope of growth in India, because as and how more people start earning, they have mobile phones and they can buy insurance very easily via Paytm or through their mobile phones. The insurance sector is expected to witness a phenomenal growth. This is true for not only life insurance but also non-life insurance, like let's say house insurance or car insurance, which is why the recent boom in the insurance stocks. Now, if you feel this is going to sustain, investing in a life insurance pack or an insurance pack becomes a very easy way for you to get exposure to that entire sector by merely having that one view that this is an industry which will do well in the coming months. Now, similar to investing in sectors is actually investing in group companies. Now, what are these group companies? Um, these group companies are essentially large business houses of India. Business houses and names that almost anyone who's, almost everyone in India is impacted by them, even if they have not heard about them. And anyone who's in the stock market would have definitely heard about them. These are business organizations like Tata, Birla, HDFC, ICICI, L&T, Godrej, which are large and established names that have been around for a while in the Indian corporate and economic scene. Why is it why is it now the question is, why is it a good idea to invest in these group companies or in these large and established businesses? See, the main reason is essentially everything, even in the world of economics and investments, runs on trust. Essentially, it's a very human thing that trust is paramount when dealing, when doing business. Trust is paramount when it comes to also the stock market. Organizations and managements that have been able to deliver consistently year on year, they have been able to live up to their promises or even give unexpected benefits to their shareholders. Over time, they have earned the credibility and trustworthiness of the entire stock market. The market is a lot more likely to give them more leeways, to be more understandable to their plans, to be more patient if things don't go out as per plan. And they also have this trust that these groups have inspired in their shareholders over time. Now, that itself becomes a great identifier to see whether or not this this business will continue to do well, because ultimately everything in the market is about trust. Even if a company has done no wrong but it has lost the faith of the market, it can crash very quickly, as we have seen in numerous cases in the recent past, whether it's DHFL or Yes Bank. On the other hand, even if things seem suspicious, but there is a lot of trust and credibility in the overall management on the overall operations of that company. Let's take the example of Infosys here. Then even if something seems wrong, or even if a minor things do go wrong, the market is a lot more likely to forgive them and to continue keep on having that faith in them and give them the chance to fix their errors and actually continue building and creating wealth for shareholders from there on. That is why trust is super important when it comes to investments and in the world of investments. And that is also why investing in companies that belong to these established and large business houses, which have earned the trust and reputation of the entire market over many years, ends up being a great idea. And on the HDFC small cases platform, you can find I think about 6 or 7 packs that come from these established and reputed group companies, including ones from the HDFC group or the Godrej group, Tata and Birla groups. um, they've all done very well over the long term, and the minimum investment amounts also are not that high, as you can see. So do take a look at them as well, because while you may have exposure or you may have defined views on a particular sector, this is also another way to track a larger group of companies that probably in may or may not necessarily be confined to one sector, but they have one thing in common, which is that group reputation and that group trust. um, so with that, we've covered most of the things as to why you should want to invest in sectors or group companies. But one thing which I feel we should discuss is also the associated risks involved when if you are investing in a particular sector or a group company. See, the first thing is that, like all equity investment, investing in sectors is also risky. But uh, in addition to that, there are a couple of things which make investing in a particular sector even more, I would say, something that people need to be careful of, is that when you are investing in a particular sector, you are putting all your money in that particular sector. Now, of course, if your views are right, you will be rewarded by playing that concentrated bet. For example, if you had the view in early or mid 2019 that insurance companies will do well, that kind of an investment would have played out very well since then. On the other hand, if let's say you would have had a view that auto industry is going to do well in 2018 or 19, it's very likely that your investment would have underperformed because the entire sector was facing all kinds of slowdowns. Now, this risk of economic slowdowns is obviously there, but when it comes to investing in particular sectors, it is the risks are even more prominent because there is a risk of a government policy change or new regulations or taxes that are very specific to that sector only. Now, for example, in the case of autos, one of the core fighting points that has been there, push and pull in this in terms of reforms has been what will be the GST, in the new tax slab. Is it going to be reduced or not? As a result of which, a lot of people have delayed buying cars and automobiles. Now, this is something which impacts the entire industry, but it is also something that the entire industry cannot control. It is only something that the government can set and determine and bring clarity on. So these kind of risks, which are not specifically related to the economics of that sector, also exist when you end up, investing in a broader sector. The other thing to keep in mind is because of globalization today, there are a lot of moving parts. There are a lot of things that influence a particular sector, which one needs to track and be aware of if they are doing that, individually on their own. For example, when it comes to um, let's say the automobile, specifically the electric cars, right? You will need to track what is happening in the lithium sector. You will need to track what is happening in the power sector. Within power, you will need to, let's say, understand, if you're interested in just the power sector, you will need to understand what is happening with the pricing of these units, what is happening to coal production in India, what is happening with the other raw material and inputs required by the power sector. Are there any laws and policy changes coming this way? So these are all things that, need that people that any investor should keep in mind if they are looking to invest in sectors. If on the other hand you decide to choose to invest in one of the packs or small cases that track a particular sector or a theme, then in that case, that work you don't have to do. The research team is going to do that work and update the portfolio constantly. um, and lastly, let me leave on this note that even if you're investing in sectors, its diversification still remains the key. So rather than investing in one company in that sector, it's far better that you invest in 5, 6, 10 companies in that sector, so that even if the sector does well and the company, let's say a few companies don't, you still end up winning overall, because you have bet on the overall sector rather than a few companies in that sector. So, diversification still remains the key, whether it is in investing in equities in general, or it is investing in sectors, specific sectors. So with that, everyone, we will conclude this webinar. It's time to take and answer all the questions that you may have had throughout. So let me quickly end this presentation and just see how many questions we've received and take a stab at answering them one by one. One second. Okay. Okay. Just bear with us a minute. We are still trying to pull up the questions that you guys would have sent in. One person has asked whether the recording of the webinar will be available. Yes, the recording of the webinar will be available for you to view. You can find that on the HDFC Securities website, as well as I think it will be, if you've signed up for it, I think you will be notified about it. Okay. I'm not sure if I see any other questions. Let me just wait for 1, 2 minutes and see if there's any question that has been missed. All right, ladies and gentlemen, it looks like we don't have any other questions. Thank you again. Oh, wait. Okay, two questions. One is from Mr. Sandeep Singh, who's asking, so what about infrastructure stocks like L&T? So, we are currently we don't have an infrastructure tracker on HD available on HDFC Securities, but I think it is being researched and worked upon right now. So even if you don't find one right now, very soon you should have a pack small case that tracks specifically infrastructure. Um, on the other hand, if you're interested in L&T and companies or L&T group companies, there is right now a pack called the L&T pack, which invests only in L&T group companies. So you can look at that instead. Um, how about the power sector? So there is an oil and gas pack right now, which tracks only the oil and gas industry. I Let me quickly double check something. I believe there is an energy pack, which is a broader one, which is tracking the more angles of the power sector. So let me quickly check that. Yes. So there's an energy tracker available which is looking at oil and gas and even natural gas, hydro and nuclear power sources of energy, as well as wind and solar. So this energy tracker actually is gives you an overall comprehensive exposure to the overall energy space or the power space. On the other hand, if you're interested only in the oil and gas part of it, there is an oil and gas pack as well, which you can invest in if you want more concentrated exposure to only oil and gas. Uh, all right. It seems like those are all the questions that we have for now. So thank you everyone for your time and for attending, tuning in this Friday afternoon for this webinar. We hope you have a great weekend, and thanks again. Happy investing.